Hello, and welcome to the lecture on property, infrastructure and alternative assets. But for just this video, I'm going to focus on property. Your module objectives for this week. So by the end of it, you should be able to discuss the different types of property-based investments that we have available, outline the different components for how the return is made up for property investments, compare the different ownership options, and then for infrastructure, which will be a separate video, identify the different types of infrastructure available for investment and what are the major types of alternative investments. Let's get started on property. So what property assets can you invest in? What can you think of? Well, there are the really obvious ones that probably spring straight to mind, such as investing in buying a house to rent out. Apart from a house or a flat, are there any other types of property assets that you can think of? Let's go and have a look. So we've got a lot of different types of property, and some of these may not spring to mind straight away. So for example, you could invest in agriculture. So we've got grapes here, a vineyard, something more unusual, perhaps an amusement park, or even a car park. That's something you probably wouldn't think of. We would normally be thinking first up of a home or a flat. Investing in the more industrial type property, such as a warehouse, is another option, or perhaps something like this, a shopping centre. So there's a Westfield one. They're invested in shopping centres, and superannuation funds often invest in shopping centres. So my local shopping centre is owned by a superannuation fund. And then we can just look at vacant land, or perhaps freeways, or even airports and railways. Let's go and look at these some more. So property is a really important asset class, and as you know from talking to people, it's very popular. What's really interesting is that it gives people who are investing in property stable income. That's what people are looking for. They're getting their income via rent usually. And it has a low correlation to other asset classes such as shares and cash. So a low correlation. So remember, when a low correlation, that's going to be really useful in a diversified portfolio. It'll make it when one's going up, the other is going down. It's not perfectly correlated, but it's low correlation so that it evens out what's happening in your portfolio. So what types of property do you have? Well, we're just talking about some of them. So commercial, for example, offices, shopping centres, industrial, factories or warehouses or storage. Residential, that's the one we're particularly familiar with, buying a house or an apartment. But we could also invest in property that's rural, which is a farm or agricultural. Then there are special purpose property, such as buying ones for healthcare. There are precincts now for medical, different types of doctors all coming close together. Caravan parks, that's something more unusual, or amusement parks. Then we've got infrastructure. Now we are discussing infrastructure in here with property. It's a bit of a question mark whether or not we would definitely include it in this category. On what we're talking about with infrastructure, roads, pipelines, railways, those kind of things, the electricity poles. Here are our 5 asset classes. We've already gone through this semester cash and fixed interest, which is our bonds. We've done our shares. And this week we're looking at property and alternative assets. So when we're focusing specifically on property, where are we getting our return from? That's what we want to know for each of our asset classes. So if we've got the type of property that's rented out, then we're going to be getting rent as our income. We would also be expecting growth from property, hopefully capital growth and not a loss. It is still, of course, highly possible, that you could have a loss. So property, very common example, residential property, but don't forget about the other more unusual ones, commercial property, industrial property, vacant land. Well, they're not that uncommon. And then infrastructure, when we're discussing that, we're talking about pipes, toll roads, bridges, dams, power stations, railways, those kind of things. So it's important asset class within a diversified portfolio because it gives us a stable income via the rent and the low correlation that we talked about before. But there are risks involved in investing in property. So let's think about some of those. We've got the value of the asset increasing and decreasing. There's no guarantee that property, people always talk about property going up, but it's not necessarily true. There's a cycle, so it goes up and down. If you're buying it at the high part of the cycle, then you may see the value of your property decreasing. Vacancies are a problem if you're renting out this property. Increased competition. So we often see, for example, blocks of apartments and flats being built, new blocks, so that people have the option to go and rent in a shiny and newer flat. Perhaps there are too many flats now around from where your place is. That's causing the overdevelopment. There are costs involved in property. You have to maintain them and pay all the fees for them, strata fees if they're in an apartment. There are occupancy rates, so it's not easy to keep them fully rented, and there are also regulatory changes. So you used to be able to claim, for example, going to visit your property investment, but now the rules have changed and you can't claim it. So there are always changes happening with the regulations, and that can impact on your investment. Here's our risk return graph. So we've got down here cash and fixed interest, our bonds we've looked at. Now see how we've got these little circles here? So there, the width of the circle is we're representing the range. So even with bonds, which is our fixed income, we have a range. So we could have our government bonds, which are very safe and secure, extremely low risk, but also low return. But within that category, we also had the corporate bonds, so higher risk, higher return. So there's a range, and that is the same within property. So you can see there's a range. So there's this risk, and then down here you can see it's stretching from a lower risk to a much higher risk. And of course, we would expect a higher return. So property is fitting in here in the middle, after cash and bonds and before shares. Okay, so how do we buy it? Well, one of the common ways is to directly buy it. So it's very popular for people to go and buy their investment property. That means that they're owning it in their own name. That if you own it in your own name, you're fully responsible for all the bills. You've got to maintain it. So when something breaks, you've got to fix it. You've got to figure out the rental agreement and the taxes. So you might go and hire people to help you with these, which is more cost. Now, direct property may give you less volatile returns than listed. Most of the direct property investment is with buying a residential property. It's a lot cheaper than going and buying, for example, a shop in a shopping centre or a farm or something like that. So for most people, this is the cheapest option. However, it does require a considerable amount of cash. So it will use a lot of your funds up. There are liquidity constraints and transaction costs. So yeah, it will strongly impact your liquidity. let's look at the pluses and the minuses of directly owning an investment property. Okay, so what's good about it? So starting with the benefits, property can be less volatile than perhaps shares or other investments. You have this guaranteed, you've got this income. As long as you've got tenants in there, then you're getting this regular rental income. And if it increases in value, you're going to have a capital gain when you sell it. There are some tax deductions available for investment properties. You can offset the costs against your rental income, and that includes the interest on any loan used to buy the property, not the actual payments to reduce the main loan, but the interest part. You've got something that you can physically hold and touch, so that's very attractive to people. They can see their assets, feel it, and that makes people feel really good. You don't need any fancy knowledge to have an investment property, unlike some of the more complicated investments. So these are all the good things about having an investment property. But there are also the negatives. So there is a cost. So your rental income, it may not cover the mortgage payment or all the expenses involved. So if it was a house, for example, you've got your rates, the maintenance. It always amazes me how things keep breaking. And you just have to keep fixing your house. You've got to keep it. There's always constant maintenance that you have to be doing. Interest rates. Now, we're very fortunate at the moment with our very low interest rates, but have a chat to some older people about what were interest rates like before. This could happen again, and people need to be prepared for an interest rate increase and being able to pay the higher mortgage and having less cash available. Tenants do leave, and there may be times when there are vacancies and you have to be able to pay the mortgage and all the other bills. It's inflexible. Unfortunately, if you need a bit of extra cash, you can't just carve off one spare room and sell it. Now, wouldn't that be handy? I don't need that bedroom anymore. I just sell that back to the bank. But no, we can't. You can't. Whereas with something like shares, got 1,000 shares, you need some cash, you could just sell 100 shares or whatever it was that you needed. You can have a loss of value. If it goes down, what happens is the price of the value of the property goes down, and it can actually be less than what you owe. And that would be negative equity. And there are also high costs with purchasing and selling a property. So for example, there's stamp duty, legal fees, and if you're renting out and using a real estate agent, which is probably a good idea to handle all the tenants, like checking the tenants and collecting the fees, collecting the rent, so you don't have to do that, but they have fees. So this can make buying and selling property very expensive. So that was direct ownership. Another way of purchasing is through a syndicate. So a syndicate is a group of people coming together and they're pooling their money, they're sharing it together. So that means that you don't have to find 100% of the cost for that investment. So you make an initial contribution to a scheme. So the scheme could be a management investment scheme, it could be a trust or a fund, and in return you receive your income during the life of the syndicate. And you should get a capital return at the end. They normally have a set time period that this would go for example, 5 or 10 years. And each syndicate has a different objective. So perhaps that syndicate specialises in properties with long-term leases, or perhaps they're looking for strong returns and good capital growth. Perhaps they were just interested in those distressed assets with no tenants, but the possibility of significant development upside later. Now the downside of this is there's a lack of liquidity. So what's good about having a syndicate? Well, instead of finding 100% of your capital up front, you only need to find part of it. So you might be able to buy something that is bigger or that you would not have been able to afford yourself. The syndicate could buy this because everyone is pulling their money together. So it helps you with your portfolio. You could get a larger property with greater potential growth with a smaller outlay. And then you can use those funds that you've saved to invest in something else. So a property syndicate will give you some diversity. They can access different types of property that you would not have been able to on your own, and they should. And they're also good because they'll have professional management, so that it's being managed. You don't have to worry about doing all that work for yourself. On the other hand, we've got our risks, so there's less control. It's not just you anymore picking what kind of property you want. We've got a group of people pulling together. So you have less control, you don't get so much say in the decision making. The managers have to think about the interests of others. It might not align to all of the investors' needs and requirements. Perhaps you particularly object to purchasing a particular type of property or where it is, but you may not have the say. You are relying on the managers, so there is a risk with the manager. They may have problems with their staff, they may have financial stress, and there's less liquidity. So they're for a fixed term. So you get your money back, say at the end of the 5 years or 10 years, but you can't just sell the house, the property before then. So we've looked at owning the property directly yourself, and we've looked at owning it in a syndicate. So the third option we're looking at now is listed property. So this is where you're buying shares in a fund or a trust, which uses that money to invest in a portfolio. Well, no, they're not necessarily using the share money, they're using the initial money to invest in a portfolio of real estate assets. So this could be really handy to be able to diversify wildly and widely. This would give you an opportunity to be able to get into those larger properties, such as commercial and industrial ones. So listed property tends to be a liquid investment, like shares, but just like shares, the price can go up and down. Currently, we've got listed real estate representing about 8% in the share market. So what's the key issue with this? So valuations in the share market can see listed investments trading at a premium or a discount to what their net tangible asset calculation is. So types of listed property, you'll see real estate investment trusts. So these are funds composed of investment properties managed by professionals. So the properties could be local in Australia, or they could be overseas, residential, commercial and industrial. This is really useful. It can give you the opportunity to diversify within one fund. Now, real estate investment trusts are limited to local properties, so they're called Australian real estate investment trusts. And the main difference is that the market exposure is just here in Australia. Another option is to purchase exchange-traded funds. So exchange-traded funds come in all different types of themes, so you can pick one that is focused on property. So instead of being a broad range, they're only purchasing property in the real estate sector. And then you can have property trusts, also called syndicates, which are managed funds with a professional investment manager. So the manager is taking care of the duties, managing the properties, and the investors get their share of income and then the capital later on. Which type's best? Well, you've got to think about all these issues here. So what size of investment do you have available? What is the need for diversification? If you're buying a real estate, say you're buying a house or a flat, a residential property, what think about what proportion that is of your portfolio. Should you be diversifying and having money elsewhere in other areas? What kind of management is needed? What's yours or the investor's loan serviceability? What's the investor's income? The amount that they earn, but also how secure is that income? You've got to be able to pay that mortgage every month. Are there any other liquid assets that you could use to fund any potential costs that crop up? What's the time period that you're looking at for this investment? Do you have the ability and the time to research the investment? And are you happy to leave your funds for the long? This is another long-term investment, at least 7 years. So are you willing to let that fund sit there, your funds sit there and not be accessible for that time period? And are you able to help manufacture returns? So what we're talking about there is, for example, are you able to do some renovations to help improve the return? Okay, well, that's our discussion on property. What can influence property returns? Well, we've seen interest rates definitely influencing, haven't we? Interest rates have been very low. We've seen the prices shooting up. On the other hand, wage growth. So we've seen the wage growth has not been going up. That's been staying still, and that's making it harder for people. You've got to look at serviceability and supply. So people, I think another reason for the house prices at the moment shooting up is that not many people are actually selling. What's the quality of tenants that are available? What repairs and maintenance are required for this property? What's the current government legislation and what's the talk? You often hear them, they're talking about making changes to what people are allowed to claim. Are there currency issues that will impact the return if it's overseas, for example? And what are the economic conditions? Okay, that really is the end of the property talk.